Hello everyone, my name is Sarah Martin and I have been a corporate credit and valuation trainer with Euromoney for around 10 years. Prior to that, I spent 17 years working in the city and I have a degree in economics from the LSE. Today, I'm going to spend around 10 minutes discussing net debt and its importance for financial analysis, credit assessment and valuations. The webcast is in 4 parts. First, we highlight recent trends in debt issuance and credit ratings. Second, we look at how to define net debt. Third, we look at some net debt calculations, in particular at how firms generally try to make their net debt appear lower than it really is. And finally, we look at how sharp changes in net debt can radically change valuations. So, in terms of the objectives of this mini webcast, by the end of it, participants should understand the nuances of defining and calculating net debt, and also understand how sudden changes in the market's perception of net debt and its sustainability can impact equity valuations. As you can see from this slide, the net debt of rated US corporates has risen 75% over the last decade to over $11 trillion. Moreover, since 2013, cash balances as a share of net debt have clearly fallen, suggesting lower liquidity. The trend of rising net debt is even more marked in emerging markets where US dollar debt has risen fourfold over the last decade. Corporate leverage levels are now above the 2008 levels on many measures. So why has net debt risen so much? It is due to low interest rates, which make debt relatively cheap versus equity. And as investors have searched for yield, they've moved out of government bonds into high-grade and high-yield corporate bonds. What have firms done with all this debt funding? Well, they have spent most of it on share buybacks, higher dividends, and leveraged M&A. As you can see from this chart, what they haven't generally done is invested the funding in fixed assets. Clearly, the ratio of capex to fixed assets has fallen, suggesting that earnings and cash flow growth have not grown in line with net debt, such that leverage ratios like net debt to EBITDA have and will continue to increase. Note also that rising US interest rates and a strong US dollar versus most other currencies will compound this problem of high leverage. The rise in leverage has obviously impacted credit ratings. Over the last 20 years, the percentage of rated corporates that are investment grade has fallen from 2/3 to only 45% today. That means 55% of US rated corporates are high yield. Once a firm's rating falls down to the single B level, its access to the credit markets may be restricted and its share price can be highly volatile. So, in terms of defining net debt, IFRS does not define the term, but leaves firms to come up with their own definition. Firms normally try and minimize the amount in order to enhance their perceived financial strength, their future borrowing capacity, and their covenant compliance. Lower net debt would also mean a higher share price, since enterprise value minus net debt equals the equity value. Many analysts don't even question the firm's definition of net debt. As we will show, the firm's definition of net debt can be well below the real figure. Also bear in mind that some companies will choose a fiscal year end for their balance sheet that shows net debt at its lowest, and after the balance sheet date, net debt can increase markedly as working capital investment increases. The definition of net debt will be set out in the firm's loan documents, but this definition is often quite narrow. At its simplest, net debt is gross debt less cash and equivalents. Gross debt would normally include bank debt, finance and capital leases, bonds, and commercial paper. However, what about all these other categories of liability and quasi-debt? And what about off-balance sheet liabilities such as operating leases, securitized receivables, vendor funding, and contingent liabilities such as lawsuits and guarantees? You can see that by adding in or excluding some or all of these amounts, we end up with very different gross debt figures. And what do we mean by cash and equivalents? IAS 7 gives us a fairly narrow definition based on liquid financial assets. However, by including some of these other amounts, we can again arrive at very different levels of net debt. Firms will often net off these amounts against gross debt, to reduce their apparent indebtedness. However, for the analysts, it's usually best to be conservative. If you miscalculate net debt, you misprice risk and misassess the firm's share price and financial strength. Here are a couple of examples of firms' net debt calculations. Sainsbury's, which is a major UK retailer, tells investors that at fiscal year end 2015, its net debt was £2.3 billion, implying a leverage ratio of 1.7 times, and that would mean that Sainsbury's would be comfortably investment grade. However, our calculation adds in operating leases, the pension deficit, and an imminent dividend payment, and the figure rises fourfold to £8.6 billion, an increase in the leverage to 4.4 times, which would imply a much lower credit rating and equity valuation. We can see the same with Air France-KLM. They disclose their net debt at €5.4 billion, but our calculation gives a figure of over €18 billion, excluding contingent liabilities, and this means a leverage ratio of nearly 8 times, which implies a very weak financial situation. Bearing in mind that the firm's market value is only about €2 billion, these are very significant amounts and indicate that the firm would be very hard pushed to reduce its debt levels. Glencore is very disingenuous when it comes to defining net debt. It states that net debt in mid-2015 was under $30 billion. It does this by deducting inventories, but since these are part of working capital, this isn't really feasible. Our calculation puts net debt $20 billion higher at nearly $49 billion, a leverage ratio of over 10 times, which is very, very high. The following slides show the valuation impact of a sharp rise in perceived debt levels. Here in Q4 2015, Volkswagen's equity value plunges by €70 billion to €49 billion when the market realizes its net debt will rise materially to pay for fines and compensation associated with its emission scandals. More recently, in Q1 of 2017, Toshiba's equity value plunges due to the market's realization that it has no equity left, it is totally debt funded, and its operational cash flows will not be able to service its net debt, leaving its future in doubt. Here we actually have the opposite problem. If a firm's net debt is considered to be too low, then the weighted average cost of capital and return on equity are not optimized and the shares can underperform. This is what has happened to Unilever, particularly in the second half of 2016. And then earlier this year, as the firm is subject to takeover rumours and promises to lever up through share buybacks and higher dividends, its equity value rises sharply. So, to conclude, corporate net debt has risen sharply over the last 10 years. Analysts should make sure that they do not just accept the firm's figures, but that they calculate the amount conservatively themselves. Otherwise, they will misprice risk and will overstate the firm's financial strength and equity value.